David Creighton, I'm CEO of Cordiant, founder and chief bottle washer. We started the company 12 years ago, have done about 200 deals across 50 plus countries, emerging countries around the world. Significant and growing portion of that is in Africa. So we've done about 36 deals in Africa across 16 different countries. We are focused on the private markets. We have one private equity fund and four private debt funds. And while I agree with Mark and his comments about the benefits of doing private equity, having seen both sides of the equation, I personally believe that the risk-return profile on debt is substantially better. Again, we have the ability to be able to engage with management and to affect change. But on the debt side, one of the key things that was alluded to earlier today is just the massive funding gap that is taking place across the emerging markets and in Africa in particular. And that is, to a large extent, a result of Basel III coming over the horizon for all the Western banks. The local financial institutions are able to fill up some of that gap, but not enough of it. And a lot of the funding requirements that are needed for these companies is longer term. Especially if you're thinking about infrastructure, but that's where the opportunity is. And there are really three different sectors that you can look at or strategies of investing, and one is the extractive industries, and traditionally that's really where people started out. Extractive industries obviously are highly linked to the price of the underlying commodity, which has nothing to do with the people who are producing it. The second is manufacturing for export, again, subject to the whims of the international markets that you're selling to, and if the Western market decides to slow down, then that's going to affect the business. And the third is local consumption. And I think that's really where you get the most robust exposure to Africa and the emerging markets, but Africa in particular. And we know the story of these 200 million people who are all on the journey moving from subsistence living to having disposable income and all that they require in order to be able to move up that ladder. So financial services, power generation, cell phones, cell towers. We've gone into foam mattresses and these sorts of things. I mean, these are a broad range of sectors. But one of the things that we really get a kick out of is being able to tap into what I call the perception arbitrage. And this is that people tend to think that that Africa in general and many of the countries that we're operating in specific are really just unlawless or lawless, impossible places to do business. And the fact is that our experience has proven that to be quite wrong. An example of one consumer-driven business in a difficult place would be a petrochemical processing plant in Port Harcourt in River State in Nigeria. This is one of a small number of countries or areas around the world where you cannot get kidnap and ransom insurance because the security issues are so high. And you take a look at the big multinationals, they're all backing out and really they don't know how to manage that risk. Taking a more holistic view and understanding what those risks are, we then structure the deal in such a way that we engage with the local community by making, the displaced landowners who were thrown off the land in order to build the plant in the first place, we gave them equity, 5% of the equity. 5% of the equity also went to the local community, and another 5% went to the workers. So all of a sudden, rather than having the typical structure that you would expect around there of barbed wire fences and all that, and all the security issues that are with that, instead what you have is a buy-in support from the local community and a business that's operating incredibly well. For that, and here's the perception arbitrage, for that, we're getting paid an extra 300 basis points above what a similar credit would generate. So there's the opportunity. It's very straightforward. And just again on debt versus equity, I mean, Mark talks about 53 different countries. I'm sorry for picking on you, but
no, I like it.
He talks about 53 different private equity firms. It's starting to get a little bit busy. There's a bit of competition for deals and that sort of thing, which I guess is good for the sellers of the business, but not necessarily good for the investors and the funds. I don't know how many debt funds there are, but we're the only ones that are doing the strategy that we're doing. There are a couple of others who are doing sort of mezzanine and some distressed, but sticking very much to the senior secured top end of the capital structure, we're the only ones. So there's a lot of space to be able to go out there and find wonderful deals.
Doing business in Africa, you can't afford to be without Africa Investor.